Financial Accounting video tutorial. In this tutorial we're going to look at the area of depreciation, and to do that we're going to work through a question called Mr. Peters. Copies of this question and other questions with links to video tutorials are available at https://danielkingaccounting.wordpress.com. So to start with, we will have a look at the Mr. Peters questions. So remember, when you're doing this, you can pause or rewind at any stage. So I'm now going to pull up the question. So here we have the question in front of us. I'm going to read through the question from the top here. So if we see at the top here, on the 1st of January 2015, Mr. Peters bought a Peugeot van for $45,000. On the 1st of May 2016, Mr. Peters sold the Peugeot van for $15,000 and bought a Renault van for $55,000. Now, Mr. Peters depreciates vans at 25% per annum on the straight line method, which means it's 25% on the original cost, and he depreciates his assets that he owns at the end of the year, which means if he owns it on the 31st of December, it gets a full year depreciation. If it's not owned at the end of the year, 31st December, there's no depreciation. Now, what are we asked to do? Well, we're asked to prepare the asset account, the provision for depreciation account, and the disposal account, and record the above transactions for the years ending 31st September 2015 and the 31st September 2016. And then also prepare income statement extracts and the statement of financial position extracts that are required to show the above transactions for the years ended 31st of December 2015 and 31st December 2016. So to start with, we need three ledger accounts. We need the asset account, we need the provision for depreciation account, and the disposal account. Now, I've already got these set up, so if I just go across and we'll have a look at them. So here are my accounts here. I have the asset account for the van here. I have the provision for depreciation account for the van here, just down below it. And then if I scroll further on down, I have the disposal account. So they are the three accounts we need. So if you're setting this up to work on it, you should consider leaving about 8 to 10 lines for each account. So starting off then, we have on the 1st of January 2015, Mr. Peters bought a Peugeot van for $45,000. So I'm going to write in here on the debit side of the account, the 1st of January 2015. Now we'll assume he buys it through the bank. So what I'm doing, I'll be crediting the bank and debiting the asset account with €45,000. Now, if I just go back to the question, we can see here that that's all that happens. So that actually is the end of 2015. So what I'm going to do now is I'm going to balance off the accounts at the end. So going back here, I'm going to put in a column total here. So my column here is 45,000. Over on the credit side, I'll put in a column total 45,000. And of course, this side here, the credit side doesn't add up to 45,000, so I'm going to put in here 31st of the 12th, 2015. This will be my balance. Carry down 45,000. And of course, this gets brought down onto the debit side. So I have the 1st of January 2016 balance brought down 45,000. Now what I need to do is I need to put in the depreciation for 2015. So I just scroll down to my depreciation account and I'll put in here end of the year 31st of the 12th 2015. Now this is going to be double entered to the income statement. So I'll put in income statement, and it'll be an expense in the income statement. So it'll be income statement you have depreciation expense, and you put the amount in here. So if I just go back to the question here, we just take this off up here. So we have 45,000, and it's being depreciated at 25% per annum. There's the 25%. So 25% of that is 11,250. So my depreciation for the year, that'll appear in my depreciation account, is 11,250. So I go back here to my provision for depreciation account, and I'll put that in. So I have 11,250. So remember what's happening here is I'm crediting this account here, and I'll be debiting the expense account. Now that's the end of the year, so I'll balance this off, 11,250. On the debit side, I'll put in my column total, 11,250. Of course, it doesn't add up to 11,250, so I need to put in my balancing figure. So my balance carried down on the 31st of 12, 2015, 11,250, and then on the 1st of January, 2016, I'd have my balance brought down 11,250. So that is the provision for depreciation account and the asset account done for 2015. So what I need to do now is I need to just go back and have a look and see what happens in 2016. So there's a couple of things happening in 2016. We'll deal with them one at a time. Firstly, on May, Mr. Peters sells the van for 15,000. So we deal with that first, and then he buys a new van for 55,000. We'll deal with that second. So back to our asset account. Now what happens here is Mr. Peters is getting rid of the van. So what we have to do here is we have to take the van out of the asset account. The asset is actually gone, and it's been sold on the 1st of May. So I'll put in here the 1st of the 5th, 2016 now, and it's been disposed of. So I'll put there double entry to disposal, and I'll put in the original cost. So what I'm doing here is I am crediting the asset account, and then if I just scroll down here to my disposal account, I will debit my disposal account, 1st of May 2016, and we have asset, the van, and the amount is 45,000. So I've taken the asset out of the asset account and double entered into the disposal account. Now if I go up to the depreciation account, I have to do the same thing. Anything to do with the asset that we're getting rid of has to be removed from the accounting system. So I have here then the 1st to the 5th 2016 to disposal, and it's the depreciation that we've charged on the asset that we're getting rid of. So I'll debit the provision for depreciation account, and down here I will credit the disposal. Provision for depreciation, and it's 11,250. Now I'm just going to go back and check and see how much he actually sold it for. So if I go back to the question, just turn over to the question. So here the question we see, he sold the van for 15,000. So what I have to do is I have to double enter that in. So if I go back to my account, I'll put that in now. So back here in my disposal account, what I now put in here is the 1st of the 5th 16 bank. So Mr. Peters sold the asset for 15. So someone gave him 15,000. He would put it into the bank. So you debit the bank and you credit the disposal account. Now, if I just move this up here a little bit, give me more space, I'm now going to close off the disposal account. So I'm going to get a total on either side. Now what I have to do here is to check and see which side is the bigger side. And by looking at it, I can see the debit side over here is the bigger side. So I'll write in the column total there, 45,000. And over here, I'll write in the column total 45,000. Because this column here doesn't add up to 45,000, so we need a balancing figure. Now, the balancing figure here, I need to work that out. So if I work that out, I can see the difference, or the balancing figure here, will be 18,750. So I'm going to write that in there. Now, you never have a balance left over on the disposal account. So what's going to happen here, on the 1st of May, I'm going to have that as a loss on disposal. Which will be an expense in my income statement. So there's no balance brought down here. The difference here, the balancing figure, is a loss on disposal, and that figure will go to the income statement like an expense. So you'll have in expenses, loss on disposal, 18,750. Okay, so that is the disposal account completed. So now I'm going to go back up to my asset account. Now, the asset account balance here will be 0 because the asset that Mr. Peters had is now sold. But he's buying a new asset. So we know that on the 1st of May 2016, he buys a new asset. So we'll presume he buys it through the bank, and he's buying it for 55,000. Now, that's it. That's the end of 2016. So we need to balance off this account here. And that will be come to 100,000. So I'll write 100,000 in over here. And this will be the end of the year then, 31st of the 12th, 2016. Balance carried down will be 55,000. In other words, it's the new van at the original cost. So starting off the 1st of the 1st, 2017, we'll have balance brought down 55,000. Now, the last little thing I have to do here is the provision for depreciation for 2016. So I'm going to have then at the end of the year, 31st of the 12th, 2016, and this will be in the income statement, and it'll be an expense, and the amount will be, well, what I might have to do here is just to go back and work out what the amount will be for the year. So back here we can see we have new asset. I'll just bring it down here, give it a bit of space. 55,000, and I'm depreciating it at 25% per annum. So at 25%, well, that will be equal to 13,750 for the year. So what I need to do now is I need to go back to my disposal account and put that in. I beg your pardon, to my provision for depreciation account and put that in. So we go back to my provision for depreciation account, and I'm going to write that in here now, 13,750. Now I'm going to balance off this account here in the usual process. The credit side here is the biggest side, and that total will come to 25,000. That's the column total. So I'm going to put 25,000 in here. Now, the difference here will be my balance carried down at the end of the year. And the amount, of course, is the depreciation on the new van, 13,750. So the 1st of the 1st, 2017, we start off with a balance brought down 13,750. Okay, and that is the end of the ledger accounts to record the extracts for the above transactions. So if you just go back to our question, you see we've completed the asset account, the provision for depreciation account and the disposal account, and we show them the transactions for 2015 and 2016. So that is that complete. So now I just need to show the income statement and the statement of financial position extracts for 2015 and 2016. So we'll go back to where we were, our working sheet. Now, so what we have here then is, if I just scroll up a little bit, we have the asset account for the 2 years, all balanced off, and a balance brought down here, we can see of 55,000 going into start of 2017. Go down through here, we have the provision for depreciation account, same thing, our balance brought down. We have the disposal account with no balance on it. It's balanced off, it's clear. Now, I just set up my income statement extracts down here, and I'm just going to do it like this. I'm just going to show what I have to put in. So, in 2015, I'm going to have the income statement extracts. I'm simply going to write in depreciation, FAN. So we'll have all the other expenses here. You'll have wage and salaries, rent and rates, depreciation, computers, and so on. But we want to show the bit we're working on. So the depreciation on the van is, well, let me just scroll back up here. And we see, there it is there. Year ended 31st of the 12th, 2015, 11,250. So I go back down to my income statement extracts, and I put in 11,250. That'll be added up then with all the other expenses, taken away from the gross profit to get the net profit. So that is it for 2015. Now moving down to 2016, I'm going to put my expenses in here. So I'm going to have depreciation on the van, but I'm also going to have loss on disposal. Now I have both those figures, so if I go back up, I can see for 2016, there is my depreciation figure. And if I go down here, in my disposal account, there is my loss on disposal, 18,750. So if I just go down here then, I can put those in. So the depreciation on the van for 2016 is 13,750, and the loss on disposal from our disposal account, 18,750. Okay, so they, as you can see here, they are the income statement extracts for 2015, and just down a little bit here for 2016. Now I'm going to show the statement of financial position extracts. So I have set this up earlier, so I'm just going to scroll down here, and I'm going to have the statement of financial position extracts for 2015 and 2016. Let's get this to fit into my screen here. So what I have is my 2015, my non-current assets. I have the van. I have the cost. Well, now I'm just going to scroll up here. Sorry, I'm going to scroll up here. Go all the way up here to my asset account, and we have the original cost, 45,000. And if I go down a little bit, I can see the accumulated depreciation, 11,250. So that's what I need to put in. So go back down here, and I'm doing 2015. So the cost is 45,000. The accumulated depreciation is 11,250, and that gives us a net book value of 33,750. So remember, it's the cost less the accumulated depreciation gives you the net book value. And then just moving down to 2016, non-current assets van, or the different van, but it's still a van, so still just under a non-current asset as van. the cost was 55,000. The accumulated depreciation is 13,750. Now let's go back up here to show where I'm getting those figures from. The asset account, there's the new asset there, 55,000, and there the income statement amount, 13,750. So I have then for 2016, which I'm working on now, cost 55,000, accumulated depreciation 13,750, which gives a net book value of 41,250. Okay, that completes the workings. So what we'll do now is we'll just go back and have a final look at the... So back here at the question, we can see what we did was we prepared the three accounts, the asset account, provision for depreciation account, and the disposal account, and recorded all the transactions. And then we did the income statement and statement of financial position extracts for both 2015 and 2016. Okay, so that completes this financial accounting video tutorial based on Mr. Peters. I hope you found it beneficial, and if you'd like to try out some other questions in the financial accounting area, you could visit my website. The address is given to you there. Thank you very much.